I told you this is starting to feel less like innovation and more like 2007 wearing an AI costume? Before we break this apart, if you want calm, clear explanations of bubbles before they burst, subscribe and turn on notifications. These are the kinds of moments people wish they paid attention to early. All right, let's get into it properly. The AI insanity keeps accelerating. As we head toward Christmas, the mood across markets feels unhinged. Everyone is chasing growth at any cost, even as the warning signs are flashing brighter by the day. The bubble is not cooling off. It is expanding, despite very real signals that something underneath is cracking. This genuinely feels like 2007 all over again, just with data centers instead of mortgages. Back then, risk quietly stacked until the system could not hold it anymore. Today, the amount of leverage and long-term obligation building inside the AI and data center space is frankly ridiculous. We might stagger through 2025, but if black swans show up in 2026, this system is wide open. Every bubble has a weak point. In this one, the weakest link is becoming clearer. Oracle. There is a reason Oracle stock is down nearly 50% from its highs. That does not happen by accident. There's also a reason credit default swaps on Oracle debt are exploding. These swaps are basically insurance against default. When their cost rises sharply, the market is telling you something is wrong. Very wrong. The market is not buying the soft landing story anymore. Think about the math for a second. Investors are paying roughly 1.5% just to hedge against Oracle blowing up. Meanwhile, Oracle long-term debt yields about 6% at best. At that point, why take the risk? You could buy U.S. Treasuries yielding 4 to 5% and avoid the stress entirely. That spread is a confidence collapse in slow motion. Now here is where the bubble starts choking on itself. Raising new money is getting harder. Look at rental rates. Look at what companies are paying just to lease data centers. Over the coming years, U.S. big tech has committed about $570 billion to data center leases alone. That is rent, just the physical buildings, no staff, no chips, no operating costs. AI hardware will add hundreds of billions more on top. This is where people underestimate the danger. Leases do not care if your servers are fully utilized or not. You pay every month regardless. If cash flow disappoints, losses compound fast. That is why even major venture firms are stepping back. These projects only work if demand arrives perfectly on schedule. Miss that timing, and you are left with massive fixed costs and no flexibility. If demand does not show up, you do not get innovation hubs. You get ghost cities full of idle data centers quietly burning cash. Blue Owl Capital pulling funding is a huge signal. They will not back a $10 billion data center tied to OpenAI. That alone should stop people in their tracks. Even if Oracle finds replacement funding, it will come with harsher terms, higher payments, more pressure, and less room to breathe. Here is the part people keep ignoring. Demand for AI is not fully controllable. You can build endless supply, but demand depends on the real economy actually being ready to absorb it. Is the U.S. market prepared for a massive AI ramp-up? Unlike China, the U.S. does not have a large industrial base ready to plug AI straight into production. Add tariffs into the mix, and suddenly AI-driven manufacturing becomes far less attractive. You can rebrand it all you want, but structural issues do not disappear. This brings us to timing. 2025 looks calm because many of these lease obligations have not started yet. That changes in 2026. A huge wave of commitments goes live then. Big tech is betting tomorrow's demand explodes right on cue. Build it, and they will come. But what if they do not? Oracle lease commitments stretch between 15 and 19 years. On average, the company will pay about $14.6 billion every year. That is roughly 2/3 of Oracle current operating cash flow. At the same time, Oracle predicts its cloud business will grow 16 times by 2030 to $166 billion. Where does that number come from? Hope is not a strategy. In 2026, the pain accelerates. Lease commitments jump nearly 6 times to $248 billion. If cash flow does not catch up, things get ugly fast. And if Oracle stumbles, the fallout will not stay contained. Entire regional economies built around these data centers could unravel. Jobs vanish. Small businesses collapse. This is a massive centralized bet the U.S. cannot afford to lose. Now, let's talk about who pays while all this plays out. The biggest losers will not be executives. It will be ordinary Americans. Why? Because data centers need one thing above all else: power. Massive amounts of electricity. Oracle and OpenAI are building a 1.4 gigawatt facility in Saline Township, Michigan. That is enough power for up to 1 million homes. Imagine the competition that creates overnight in one town. That is why the project became so controversial. There's no guarantee the economic upside stays local, but higher power bills are almost guaranteed. The U.S. simply does not have enough generation capacity to support this build-out. Just like the tariff strategy under Donald Trump, the order is backwards. Infrastructure should come first. Instead, spending explodes and problems are dealt with later. Even if every data center is built and every customer shows up, operating costs will surge. Basic supply and demand. Households end up subsidizing big tech through higher electricity prices. Every power bill becomes a reminder. Even Elon Musk has warned about this. Competing with China on energy is brutally difficult. Chinese generation capacity is roughly 3 times that of the U.S. and still rising. To catch up, the U.S. would need massive new power projects. That means more spending, more debt, and bigger deficits. That is the catch-22. And just like the final stage of every bubble, we are now watching a frantic rush for capital. Money is being grabbed before the window closes. Leading the charge is OpenAI itself. This story is far from over, but the risks are no longer theoretical. They are visible, measurable, and accelerating. Next to NVIDIA, nothing sits closer to the heart of this entire storm than OpenAI. There is a reason OpenAI is trying to raise $100 billion in a single round. That number alone tells you everything. This is not normal fundraising. This is survival funding at scale. They are already knocking on the doors of sovereign wealth funds, including capital from United Arab Emirates, because private markets simply cannot absorb something this large without choking. And here is why this moment is dangerous, no matter how it plays out. If the funding goes through, the bubble does not cool down. It inflates even further. OpenAI could walk away with a valuation north of $800 billion. Let that sink in. That would put a company with no real profitability, massive compute costs, and unpredictable demand in the same conversation as the largest corporations on Earth. That is not confidence. That is excess. But if the funding collapses, that is just as dangerous, because then the illusion breaks. One failed raise at this scale could become the pin that finally punctures the entire AI trade. Markets are not forgiving when narratives crack. And remember one thing. This AI race is not happening in isolation. The United States is not competing against itself. It is competing directly with China. And debt alone does not win that fight. Deficits alone do not win that fight. You need cheap power. You need resilient supply chains. You need an industrial backbone that can actually absorb AI productivity. Now, while this pressure keeps building, let's switch gears to a moment that perfectly captures the public mood. The controversy around Scott Bessent is more than just a viral clip. What happened to him was bizarre but also revealing. He was heckled during dinner at a restaurant, publicly called out over sanctions, oil policy, and economic pain. That does not happen in a vacuum. What made it stranger was how it unfolded. The toast, the sarcasm, the anger framed as mock celebration. It was uncomfortable, but it was also a signal. People are not just frustrated. They feel squeezed from every direction. And then there is the irony. During the ongoing farmers' crisis, Bessent publicly referred to himself as a farmer, despite having sold his soybean farms after an ethics warning. That disconnect matters. On live television, he later went on the offensive, aggressively defending himself against the heckler. So let's step back and get objective. Is the anger justified? The United States has been dealing with inequality for decades. This did not start yesterday. Production was offshored to Asia. Financial markets were repeatedly rescued through money creation. Asset owners were protected. Wage earners were not. Now look at the numbers. From 1989 to 2022, the top 0.1% captured staggering amounts of wealth. Even compared to the already rich, they sit more than $8 million ahead. Meanwhile, the median American sits around $192,000 in net worth. The bottom 20% have less than $15,000. That is not a gap. That is a canyon. If you do not own assets or control production, inflation destroys you. And with tariffs rising and investment pouring almost exclusively into AI and big tech, Main Street gets starved of capital. This gap is wider now than it has ever been. According to Yale University, tariffs alone will meaningfully damage the economy. By 2026, the pressure intensifies. Today, unemployment sits around 4.6%. That number is unlikely to stay there. The effective tariff rate is currently about 16.8%. Even after consumers substitute beef for chicken, chicken for tofu, and tofu for cheaper alternatives, the rate still sits above 14%. For households, this simply shows up as higher prices. But jobs are where the real pain appears. In 2026, GDP growth could be reduced by roughly 0.4%. Less growth means less spending. Less spending means layoffs. Unemployment could rise another 0.6%, pushing it well above 5%. And remember, that damage is from tariffs alone. Now layer that on top of the data center distortion we talked about earlier. When capital floods one sector, it drains others. Real industries suffer. And we are already seeing it. U.S. bankruptcies have surpassed pandemic levels. From January through November, 655 large companies failed. By year-end, crossing 700 is very likely. Higher borrowing costs are biting. Tariffs are being priced in. And the sectors taking the hit are industrials and healthcare. Ironically, these are the exact sectors the administration claimed it wanted to revive under Donald Trump. So yes, heckling someone during dinner is not pleasant. Bessent was clearly caught off guard, but the anger did not come from nowhere. Economic policy has become chaotic. Signals are mixed. Pressure is building. Looking ahead, 2026 is shaping up to be volatile. An AI bubble that cannot afford to pop. A chip war with China that will only escalate. Ongoing fallout from Venezuelan oil policy. And a domestic economy already stretched thin. Maybe we are wrong. Maybe the administration is right. Maybe the optimists are right. Maybe next year is sunshine and rainbows. But from where things stand, it still looks like a dumpster fire. Same, but different. Different, but same. Now I want to hear from you. How close do you think we are to an 08 style collapse? And do you think Bessent will ever eat dinner in peace again? Drop your thoughts in the comments. Smash the like button. Subscribe if you want to stay ahead of these shifts as they unfold. And as always, stay safe navigating these crazy times.